In January 2025, the financial world witnessed a record-breaking slaughter. In a single trading session, Nvidia, the undisputed king of the artificial intelligence era, saw nearly $600 billion of its market capitalization evaporate. To put that in perspective, that is the equivalent of deleting the entire value of Tesla or JP Morgan Chase in just 6.5 hours of trading. The catalyst was not a product failure or a CEO scandal. It was a model from a previously obscure Chinese lab called DeepSeek. Their R1 reasoning model proved to the world that you could achieve frontier-level performance for a training cost of just $6 million. For 2 years, Wall Street had built its entire bull case on the assumption that AI progress required an asymptotic demand for hardware. The narrative was simple. If you wanted to win, you had to spend $100 billion on chips. DeepSeek shattered that narrative. It suggested that the entire industry had been massively over-provisioning compute resources. This was the efficiency shock. It was a moment where the market realized that the moat around the semiconductor giants might not be as wide as they thought. According to data from Dow Jones, this single event erased over $750 billion from the S&P 500 index. But here's the cynical truth that the headlines ignored. While the price was crashing, the structural demand for intelligence was actually accelerating. This is what we call the efficiency paradox. In economics, it is known as the Jevons paradox. When a resource becomes more efficient to use, the total consumption of that resource does not go down. It explodes. By making AI training 20 times cheaper, DeepSeek did not kill Nvidia. It opened the floodgates for every small and medium enterprise on the planet to start building their own models. While retail investors were hitting the panic button and selling their Nvidia shares at $300, the institutional order flow from firms like BlackRock and Susquehanna showed a massive divergence. They were not selling the efficiency, they were buying the adoption. They knew that a cheaper AI is a more pervasive AI. The money did not disappear into a black hole. It moved from the hands of the person who feared the headline to the hands of the person who understood the math of the Jevons paradox. This was the first great liquidity hunt of 2025, and most people failed the test. If you thought the Nvidia sell-off was bad, you should look at what happened to the software sector in February 2026. It was a massacre that traders are now calling the SaaSpocalypse. The trigger was the release of Claude Cowork by Anthropic. This platform introduced 11 specialized AI plugins designed to automate high-value professional tasks like legal document review, financial compliance, and sales workflows. The market reaction was instantaneous and brutal. Within 24 hours, the leaders of the old digital world were decimated. Thomson Reuters dropped 15%. Relex, the owner of LexisNexis, fell 14%. Intuit and Equifax each lost more than 10% of their value. Even the legal tech giant LegalZoom plunged by nearly 20%. Why? Because the core business model of the last 20 years was suddenly declared obsolete. For 2 decades, these companies operated on a per-seat license model. Their revenue grew when companies hired more people. More employees meant more software seats. But Claude Cowork changed the logic from seats to outcomes. If an AI agent can do the work of 5 junior analysts or 3 paralegals, the company no longer needs those software seats. They need a worker, not a tool. According to analysts from JP Morgan, the US software index dropped 7% in a single day, accumulating an 18% loss for the year. The market realized that traditional SaaS is just a patchwork of interfaces and data silos. It is a system that forces humans to adapt to the software. The new era of the agentic worker is about software that adapts to the task. We are moving from software as a service to software as a worker. In this environment, if your company charges per person, you are essentially betting against the productivity of AI. The big players are now scrambling to refactor their pricing models toward consumption and organizational capability. But for many legacy giants, it is too late. They are trapped in a Kodak moment, burdened by massive headcounts and legacy code, while the AI agents are eating their lunch for the price of a few tokens. There is a darker layer to this sell-off that nobody is talking about on CNBC. It is the intersection of high interest rates and technological obsolescence. For the last decade of near zero interest rates, hundreds of software companies stayed alive, not because they were innovative, but because capital was cheap. These are what we call zombie companies. They have just enough revenue to pay the interest on their debts, but they have no hope of ever paying off the principal. Now, these zombies are facing a double-headed monster. On one side, the Federal Reserve has kept rates higher for longer, making their debt service costs explode. On the other side, AI agents are making their core products irrelevant. When a company like Salesforce or Adobe loses 10% of its market value, it is a bad day. But when a small, debt-heavy SaaS company loses 10% of its revenue to an AI agent, it is a death sentence. According to data from Goldman Sachs, nearly 15% of the companies in the Russell 2000 index meet the criteria for zombie status. As the AI sell-off accelerates, we are going to see a wave of bankruptcies in the tech sector that will make the dot-com crash look civilized. This is a controlled demolition of the inefficient. The market is liquidating the old world to make room for the new one. If you are holding a basket of diversified tech stocks, you need to look at their balance sheets immediately. If they have more debt than cash and their revenue growth is slowing, they are a target. In the age of AI, there is no room for mediocrity. The market is moving from a world of participation trophies to a world of winner-take-all. The billionaires are not just buying the winners. They are actively shorting the zombies into oblivion. This is how the wealth gap widens during a transition. The elite profit from the destruction of the old, just as much as they profit from the creation of the new. The DeepSeek event was more than just a pricing shock. It was a geopolitical and philosophical insurgency. For years, the big tech gatekeepers in Silicon Valley, like Microsoft, Google, and OpenAI, have tried to convince the world that AI is too dangerous to be open. They have lobbied governments for heavy regulations under the guise of safety. But the cynical reality is that they were trying to build a regulatory moat to protect their multi-billion-dollar investments. DeepSeek R1 bypassed that moat completely. By releasing a model that is both open weights and hyper-efficient, they effectively commoditized the very thing that Silicon Valley wanted to monopolize. This is a nightmare scenario for the big tech cartels. If frontier-level intelligence is essentially free and open to everyone, then the hundreds of billions of dollars they spent building closed systems might never generate a return on investment. According to a report from the Center for Strategic and International Studies, this shift toward open-source efficiency is forcing a total re-evaluation of national AI strategies. It means that the next phase of the AI war will not be fought over who has the biggest model, but who has the best implementation. The gatekeepers are losing control of the narrative. This is why you saw such a violent reaction in the stock prices of the hyperscalers. The market is realizing that the era of AI fat margins might be over before it even truly began. If intelligence is a commodity, then the value shifts from the model itself to the data it processes and the actions it takes. This is exactly why Palantir and the semiconductor infrastructure players are the only ones standing tall. They do not sell the intelligence. They sell the pipes and the brains that use it. The gatekeepers wanted to be the gods of the new era, but the open-source insurgency has turned them into mere utility providers. To understand why your portfolio is bleeding while the billionaires get richer, you have to understand the mechanics of the liquidity hunt. Most retail investors believe that the market is a fair reflection of value. It is not. The market is a system designed to generate liquidity for the largest participants. A massive hedge fund or an institutional bank cannot simply buy $5 billion of a stock without moving the price against themselves. If they try to buy when everyone is happy, the price rockets up and they get a terrible entry. So, they wait for fear. They wait for events like the DeepSeek shock or the SaaSpocalypse. They know that retail investors have been taught to use stop-loss orders to protect their capital. These stop-losses are usually clustered in predictable zones, just below major support levels or round numbers. To a high-frequency trading algorithm owned by a firm like Citadel or Goldman Sachs, these clusters are a goldmine. During a panic, these algorithms will use a heavy batch of sell orders to push the price down just a few percentage points further. This is called a sweep. Once the price hits that cluster of stop-losses, a chain reaction begins. Thousands of automatic sell orders are triggered at once. This creates a massive flood of supply with no natural buyers. The price crashes in a straight line. Retail traders call this a flash crash. Wall Street calls it a liquidity event. At the bottom of that crash, where the fear is at its absolute peak and the headlines are screaming about the end of tech, the algorithms switch from selling to buying. They absorb all that panic supply at a 15 or 20% discount. They are not gambling on the future of AI. They are simply harvesting the liquidity that you provided for them by being predictable. According to data from Vanda Research, retail investors were the primary sellers during the February 2026 downturn, while institutional buyers were the primary absorbers. Your fear is their fuel. Every time you hit the sell button because you are scared, you are literally paying a tax to the smartest people in the room. While you are watching the price move on your public exchange, the real game is being played in the shadows. We are talking about dark pools. These are private exchanges where institutional investors trade massive blocks of shares away from the public eye. According to the Securities and Exchange Commission, nearly 40% of all stock trading volume now happens in these dark pools or other off-exchange venues. The purpose of a dark pool is simple: to allow the big whales to move in and out of positions without alerting the retail public. This is why you often see a stock price remain stable for weeks while the insiders are selling, only for it to collapse suddenly when the news finally hits the public. Or, conversely, why a stock like Palantir can have massive buying pressure that does not show up in the price until it suddenly gaps up 20% overnight. During the AI sell-off of 2026, the activity in dark pools has reached record levels. The smart money is using the public panic as a screen. While the headlines are telling you that AI is a bubble, the dark pool data shows that large institutions are quietly accumulating shares in the infrastructure leaders. They are not buying on the public exchange because they do not want to drive the price up. They want to buy every single share you are willing to sell them at the lowest possible price. By the time the retail investor feels safe enough to buy back in, the whales will have already finished their accumulation and the price will be significantly higher. This is the hidden hand of the market. It is a system designed to keep the majority of people one step behind. If you are only looking at the public price action, you are looking at a curated version of reality. To win, you have to look at the divergence between the public narrative and the private money flow. The whales are not running for the exits. They are just moving to a different room where you are not invited. In this environment of total carnage, one company has provided the blueprint for survival: Palantir. For years, Palantir was the most hated stock on Wall Street. It was mocked as a meme stock and criticized for its secretive government contracts. In 2022, it lost over 80% of its value. Most people sold at the bottom, convinced that the company was a failure. But while the rest of the software world was selling seats, Palantir was building an ontology. They realized that AI is useless if it is sitting on top of messy, disconnected data. Their artificial intelligence platform, or AIP, was designed to be the digital nervous system of an organization. To sell this, they bypassed the traditional 18-month enterprise sales cycle and created the bootcamp model. These are 5-day immersive sprints, where Palantir engineers ingest a customer's live data and build real, working AI agents in less than a week. The results have been staggering. According to their latest filings, Palantir's US commercial revenue grew by 93% year over year. Their bootcamp engagement model has a median conversion rate of 70% within 1 quarter. They are not selling software. They are selling transformed businesses. In Q2 of 2025, they surpassed $1 billion in quarterly revenue for the first time, with total contract value bookings growing by 222%. The reason Palantir is winning while the rest of the SaaS sector is bleeding is simple. They are a system of record. AI agents are great at doing work, but they need to read from and write to a secure, organized data layer. Palantir owns that layer. As more companies adopt AI workers, they will need Palantir more, not less. This is why the stock has remained resilient, even during the broader market sell-offs. It is the difference between being a digital landlord who rents you an empty room and being the infrastructure that allows the entire city to function. If you want to find the winners of the next decade, stop looking for the prettiest interface and start looking for the deepest infrastructure. We have to talk about the role of the financial media in this slaughter. Have you ever noticed how the headlines always seem to be at their most terrifying, right at the bottom of a market move? This is not an accident. Media companies are in the business of selling attention, and nothing captures attention like fear. But there is a deeper, more cynical layer to this. Many of the large institutional firms that are buying your shares also happen to be the largest advertisers and shareholders of the media companies that are telling you to be afraid. This is the feedback loop of the elite. They use the media to create a narrative of doom. This narrative triggers the retail panic. The retail panic creates the liquidity, and the liquidity allows the elite to buy the assets at a discount. During the DeepSeek shock, the media narrative was that China had won the AI war and Nvidia was a relic of the past. Within 48 hours, this narrative had spread to every corner of the internet. Retail investors, fueled by a mixture of nationalism and financial fear, sold in droves. According to sentiment analysis from Social Market Analytics, retail bearishness reached a 5-year high during that week. But if you actually read the DeepSeek technical paper, as the institutional analysts did, you would have seen that it was actually a validation of the entire AI sector. It proved that the technology was becoming more viable, not less. The media weaponized a technical breakthrough to create a financial opportunity for their backers. This is the shakeout. It is a psychological operation designed to separate the emotional investor from their capital. If you want to keep your money, you have to learn to read the headlines with a cold, cynical eye. You have to ask, who profits from me being scared right now? The answer is almost always the person who is waiting to buy what you are about to sell. There is a massive gap growing between what the public sees and what the big money is doing. While the news is focused on the $600 billion ghost of Nvidia, the 13F filings reveal a different story. In late 2025 and early 2026, institutional ownership of core AI infrastructure actually increased. While retail investors were fleeing the volatility, the whales were doubling down. Why the divergence? Because the institutions understand that we are in a period of structural re-rating. They are looking at the Federal Reserve's neutral rate and the broader macro environment. They see that even with the efficiency gains from models like DeepSeek, the capital expenditure from hyperscalers is projected to exceed $600 billion in 2026. That is a 36% increase year over year. The demand for compute is not going away. It is just being used more efficiently. According to data from PineBridge Investments, the 2026 outlook for risk assets remains positive despite the volatility. The AI story is moving from the hype phase to the implementation phase. This is the part of the cycle where the real money is made. It is no longer about which company can build the biggest model. It is about which companies can capture the AI budget of the Fortune 500. The cynical reality is that the market needs these sell-offs. It needs to shake out the weak hands so that the assets can be reallocated to those with a longer time horizon and more capital. It is a controlled demolition of retail portfolios. If you look at the flow of funds, you will see that money is moving out of low-conviction retail accounts and into high-conviction institutional vaults. They are betting that by 2027, the companies that survive the SaaSpocalypse will be the new titans of the global economy. They are buying the fear because they know the greed is just around the corner. So, how do you stop being the prey in this rigged game? It starts with a fundamental shift in your psychology. You have to stop treating your portfolio like a scoreboard and start treating it like a strategic reserve. The biggest mistake retail investors make is being 100% invested all the time. When the market is at an all-time high, they are fully loaded. When the crash happens, they have no dry powder to buy the dip. To be the predator, you must manage your liquidity. You should always have a portion of your wealth in cash or short-term treasuries, specifically for the moments when the blood is in the streets. When you see a headline that says $600 billion has been wiped out, that is your signal to start deploying. You are not buying the stock. You are buying the discount provided by other people's panic. Second, you must abandon the obvious stop loss. If you put your stop loss at the same level as everyone else, you are just inviting the algorithms to hunt you. Instead, use a wider margin, or, better yet, do not use an automatic stop loss for your high conviction, long-term positions. If the fundamental reason you bought the company has not changed, a 30% drop in price is a gift, not a threat. Third, you must embrace rebalancing. In the era of the SaaSpocalypse, you cannot afford to be loyal to old winners. If a company's business model is being decimated by AI agents, you must be cold and cynical enough to cut it and move that capital into the infrastructure players who are enabling the disruption. You are not a fan of these companies. You are an owner of their future cash flows. If the cash flows are disappearing, the ownership is worthless. Finally, you must understand the art of not caring. The most successful investors are those who can watch their net worth drop by 6 figures in a day and not feel a single pulse of fear. They know that as long as they do not sell, the loss is only on paper. The market is a machine that rewards those who can endure pain and punishes those who seek comfort. In the AI era, the swings will be bigger and the pain will be more intense. If you want the returns, you have to pay the price in volatility. We have been here before. This is not the first time a new technology has promised to change the world, only to trigger a massive market crash. In the late 1960s, it was the Nifty 50. In the late 1990s, it was the dot-com bubble. In each case, the narrative was the same. This time it is different, and the old rules do not apply. And in each case, the initial hype was followed by a brutal correction that wiped out most of the participants. But look at what happened to the survivors. If you had invested $10,000 in Amazon in 1999 and held through the 90% crash, you would be a multi-millionaire today. The same applies to Microsoft, Apple, and Google. The elite do not care about the 90% drop. They care about who owns the infrastructure of the next 50 years. We are currently at the same crossroads with artificial intelligence. The SaaSpocalypse and the DeepSeek shock are just the growing pains of a new economic reality. The digital landlords are being evicted, and the digital workers are moving in. The system is being purged of the inefficient and the overvalued. It is a brutal process, but it is a necessary one. The brutal truth is that the headlines are designed to keep you in a state of constant, low-level anxiety. They want you to trade. They want you to provide liquidity. They want you to be the fuel for the machine. But you have a choice. You can choose to step back and look at the math. You can choose to see that the demand for intelligence is the only true infinite resource of the 21st century. The market is not crashing. It is rotating. It is moving from the hands of the person who fears the future to the hands of the person who is building it. Every time you see a red day on your screen, ask yourself, whose side am I on? Am I on the side of the person who is being hunted, or am I on the side of the person who is waiting to buy the world at a discount? The long game of the elite is simple. Stay liquid, stay cold, and wait for the slaughter. The question is, will you be at the table, or will you be on the menu?